Perfect. Welcome, everybody. We'll give everybody a minute or two to get connected, grab a glass of wine, and settle in for some great information here. Lots in the waiting room. Quick audio check for all of you joining. Welcome. And then Ryan, you'll should be able to see the attendees and all the friendly names through here. Looks like lots of mutual clients here. And we'll cover some housekeeping in just a moment. But Q&A is open and chat as well for any questions that come up as we go through. Welcome, everybody. Perfect. We are well into the triple digits for today, so give everybody another 30 seconds and we'll jump in. Yeah, it's this time of year. Every kid is sick or an incubator these days. The joys of parenting. Awesome. Perfect. Well, without further ado, welcome, everybody. It is December the 11th, 2024, 8 p.m. on the East Coast, 5 p.m. on the West Coast. Very excited about today. This is one we've had in the planning stages for quite some time. And a great new speaker joining our series. As mentioned, it's for those of you that have just joined us for the first time, welcome. Not only for our tens of thousands of clients and past clients in the past, we try to do as many of these courses as possible to really help keep educated on everything that is a change, to get a good sense of what's changing in the marketplace, and to get us some fantastic subject matter experts to talk about what is changing, what's the impact to our bottom line, what's the necessity to take action, right? And what does that mean for me and your eventual ability to pass on and protect as much money to keep it in your bank account, right? And avoid it to sending a penny more than necessary to Ottawa. So we've got clients from all the way from Victoria to St. John's, Newfoundland. So welcome across the board. My name is Eric. I'm the owner and president of Cirrus Consulting Group. Cirrus Consulting Group is this unique, hyper-specialized business that you never really think would exist outside of dental. And we've had the privilege of being really the only and the go-to preeminent solution provider for dental office lease negotiations throughout North America. And we just celebrated our 30th year. But the fantastic resource we have is Ryan Devereux. Ryan Devereux is a name that's come up so much over the past 5 years. When we ask our clients, great, and who are you working with on the accounting side? 9 times out of 10, it's one of these Ryan Devereux's. So it's a privilege to have you on, Ryan. Ryan, as a quick background, is pretty unique in the accounting space. Ryan was the tax specialist advisors to the accountants that were client facing. So 10 years behind the scene, being the tax guru and the go-to when the front-facing, client-facing accountants needed some help and guidance. So again, he is the architect and one that puts together a lot of these complicated different strategies, and we'll go through some high-level, again, best practices, call them loopholes, call them good tax practices, and just good due diligence to help ensure that we're leveraging your leverage and making sure you've got a good plan to minimize any additional tax across the board. So Ryan is a CPA, CA, HBBA, and MBA. Again, is the business advisor and partner with M&P's tax group. He works out of the London branch, but covers clients from coast to coast to coast, right? Certainly having lots of mutual clients working together. It's always clear, concise, and great consultative type of guidance. right? You're the clients, but really helping to be a devil's advocate and helping to make sure, especially for owner-managed businesses, especially dentistry, as well as real estate, agriculture, et cetera, is key. Again, from this perspective, his in-depth tax courses and teaching in tax programs, couldn't be happier to have you, Ryan. Thanks so much for joining us.
Thank you very much, Eric.
Yeah.
Appreciate it.
Perfect. So let's jump in, guys. Maybe just to get a quick sense for Ryan and I of what situations you're in at a high level, right? What your career stage is, and we'll help to customize a little bit of the content tonight, right? Are you incorporated? Are you thinking about incorporating? Are you in the first step as a young associate? Are you a mid-career doctor now thinking, hey, Ryan, is now the time to expand? Should I renovate? Should I relocate? Should I add a second location? Right? Is now the time to think about tax planning? And I heard something about, if I add one of my family members, that there's a huge windfall now. But I also heard all these, components that the federal government is bumping up capital gains, right? Help to distill some of that across the board, as well as some of you that may already have done, right? Some great estate freezes or otherwise. And now let's talk about how we can really help tweak and move that forward. So that's absolutely the purpose of today. We'll keep that poll up. If you have a second to update, that would be fantastic. So really, all we're talking about today is, my gosh, is it difficult to being a business owner in Canada these days? Every single cost, it seems like, is going up. Staffing challenges, people. I'm sure, Ryan, you hear all day long, right? And it's unique because it can certainly feel like you're alone in all of this. There's not, in other industries, there's not the same sort of dental support group. So it becomes critical as to who you build as part of your professional team and how they can support you through all the life twists and turns, right? The reminder we've shared over 30 years is, look, you're not alone in all of this, right? You shouldn't have to deal with your landlord directly. You shouldn't certainly be dealing with the CRA directly, right? Leverage the pros for things that you do, right? 2 or 3 or 4 times a year, great, do yourself. For those that you might do once or 2 times in your lifetime, right? Leverage some of the experts and certainly getting some good guidance along the way. So we want to touch on that profit, right? We want to talk about the impact of, right, the lease or purchasing real estate and how that can be. Should I buy? Should I build? Right? Should I refinance? Should I get into renewing my lease? I had a great conversation with a doctor tonight whose landlord's bumping the rent by 30%. And plus charging for parking and otherwise. And he's so frustrated, but he just bought the business a few years ago. And then again, how do we give that financial freedom? What are we working for all this for? How do we help to be prepared to sell the greatest assets? And definitely we've done presentations with doctors in the past, and they've been very candid to say, look, right, no fault of anybody other than my own, but here's the extra $468,000 of tax that I paid unnecessarily because I didn't do the proper things in advance. So, where we'll focus on tonight, again, for those of you thinking of in the early stage of your career, young associates, fresh out of U of T, etc., right, UBC, for anybody that's in that startup phase, I'm thinking of buying or building, right? What should I do and what can I do today as an associate working for a DSO or working for a different doctor, right? Mid-career, as well as, now you've realized, hey, it's tough out there and everything's a challenge, especially the landlord, right? How do we help to prepare ourselves for that? And then, of course, doctors planning to transition. Ryan, from your perspective, the mix of a lot of your clientele, where do you figure fit in the most, and where do you support the clients?
Yeah, I support clients at all stages, whether it's students coming out of dental school and helping them decide whether to incorporate or not, or, a couple of years thereafter, they start to get the itch to look at, whether they want to consider doing a startup or buying a practice. And, in that space, I encourage them quite often to start reviewing the practice appraisals, start to really kind of normalize that, understand what's going on. We're always here in the background to make sure that we can analyze the appraisals for you or help you with the business plan or the cash flow projections. But I really want them to spend some time and effort looking at it themselves, as it's likely one of the largest purchases they'll ever make. And then as we lead through debt repayment on the corporate side of things, and inching towards that sale side of things, structure becomes incredibly important as we get our debt paid down and how we can exit tax free. So we spend a lot of time on that side across, you know, general practice and every specialty. So
And we'll touch on that because tax-free, it almost sounds too good to be true. But with the top planning, I remember doing some of these with the Schulich MBA recently. And yeah, with the right structure, we went through two examples in Ottawa not long ago with Gavin, and here's a doctor that sold and paid hundreds and hundreds of thousands of dollars, and here's a doctor that sold for the same amount and paid zero in tax.
yeah.
So we'll certainly dig into that and certainly find out how and why. Just from a quick perspective here, roughly 48, 52% own versus lease, Ryan, from that perspective. 9% planning to open or relocate, 9% planning to acquire a clinic, 18% planning to transition or sell within the next 5 years. A few more coming through. And then some other components, roughly 91%, 92% now are incorporated as a quick little cross section for you, Ryan. So yeah, we'll help to cover that. And roughly 38% of thinking of buying or adding a new practice to their portfolio. Perfect. Great. So the data. So let's touch on that. So what we're seeing now is pretty unique. We're seeing that overall, we have, the markets are tough, right? A lot of the large landlords, there's been some layoffs. There's certainly been a softening in the commercial market. Retail still seems fairly consistent, but, right, you are, again, one of the best tenants on the planet, and having the data to know, especially for the 51% of you that currently own your space or unit, right? Important that, right? Again, we're aware of what market price is in comparison to what we're paying ourselves today, right? As well as to help make sure that if you are in the process of selling or transitioning, right, making sure that what you want your buyer to pay is aligned with market or maybe on the higher side, and that aligns to your long-term plan that you've worked with your financial planner and accountant. Let's talk about the lease for a second and the value of this. Yes, it's interesting. A lot of the dental schools, Canada and the US, were part of Tufts' fourth-year program, and Schulich with their MBA as part of the faculty member, is this, right? A lot of young doctors and even the professors are big advocates of ground floor retail, grocery anchored, right? Without the issues with elevators and those sorts of things. So definitely, for those of you that are on the backside of your career, definitely the demands for young buyers these days tend to be almost like clockwork, ground floor retail, grocery anchored, right? Corner type units, and having that foot traffic as a good sense of certainty. We've got lots of clients that obviously own their own units or spaces, etc. We'll touch on that. But ultimately, right, for those of you that are contemplating a second location or otherwise, right, don't look at it for $34 a square foot. Look at it over the 10, 15, 20, 30 plus years you're in the same location, and it's a multi-million-dollar check, right? So leverage your leverage. And yes, rent can be expensive, but right, there can also be certainly some good advantages and flexibilities. But I think one of the major takeaways from tonight is don't underestimate your leverage, right? So for the 49%, pretty close, that own, one of the biggest guidance we can share, 54% now, is that you are the best tenant on the planet. The landlord will never tell you this. The landlord is the lord of the land, the world's oldest or second oldest profession, right? You have the highest build-out cost, typically of any other commercial tenant. You've got the lowest default rate, typically less than 10%, or sorry, 0.05% over 10 years, right? Where restaurants, right, historical averages are well over 90%. You're in the same location typically for 26 and a half years on average. You're COVID proof. You can't work from home regardless of what your staff says, right? And obviously you are as close to a lock across the board. The most recent stats I saw, Ryan, were CIBC shared some of these at one of the recent meetings, and it was close to 9 of 26,000 doctors in the past year had filed for bankruptcy, right? So that worked out to 0.027%, which is incredibly rare, especially considering divorces and dissolutions and all sorts of other components. So, right, the banks, otherwise, banks continue to support dentists and physicians and give lots of preferential treatments and have complete departments around supporting you. But it's really about helping to make sure you've got a good plan and not agreeing to the status quo, right? The challenge we have, quite frankly, is just apathy, right? Doctors walking out after getting through COVID, Ryan, they walk out of the operatory, they're dressed in PPE and, dressed like the Michelin Man, and suddenly, oh shoot, right? The office manager runs up, hey, the landlord just called, you forgot to renew your lease and you got to sign this today. And literally in between patients, right, signing what can be a multi-million-dollar contract without really seeing that there's personal guarantees or demolition, all sorts of stuff added into it. So let's talk about profit and costs. So again, if you're the best tenant, how do we make this stuff work? Well, number one is there's really some of these 7 to 8 main financial negotiables. Each and every one are sort of like valves on the wall. How much can we turn up to turn down to maximize those long-term savings? The big difference for us is, of course, we're not brokers. We're not being paid for by the landlord. We're not being paid for a 3 or 4% of whatever the doctor pays over the next 10 years. We're always remunerated directly from the doctor. So base rent annual increase, CAM. Most doctors don't realize that CAM is negotiable, right? Lots of success we've had with either excluding certain components, what's fair, what's reasonable, 15, 20, 25% admin fee, right? Are we paying for brokerage fees or legal fees for things outside of us? Are we paying for the landlord's insurance or spouse on salary, right? What are we actually paying for? Do we have any audit rights, right? Or also, most importantly, is can we cap it? And as all these expenses are going up, we want to make sure that we can get your CAM ideally less than your neighbor next door. For those of you thinking of making a capital investment, don't do the big investment now and then renew your lease in next year or 2 years or 3 years from now. The landlord, first of all, has to be notified that you are planning a expansion, renovation, relocation, or obviously anything in between. Anything with a contract or anything more than the very basic of cosmetic needs the landlord's prior written consent. So now they know about your changes. Okay. But now from a leverage perspective, if you've just invested $500,000 in another 2 or 3 operatories and then want to renew your lease in 2 or 3 years from now, the landlord's holding all the cards, right? So if you're thinking of even a modest investment, perfect to have your lease looked at, figure out when your lease is coming up for renewal. And even if it's a few years out, it's not a bad opportunity to dangle a new 10-year term and see what the landlord might be willing to do to actually even cover some of those costs. We've seen some great examples. We did one in Boston recently. We secured the doctor over $292,000 to move next door because the landlord next door was, desperate and would love to bring in a well-established dentist with a full client base. Fixturing free rent, try to minimize that cash burn over the first 3, 4, 5, 6+ months. Be careful with tenant improvement allowance, right? I won't speak for Ryan, but it's always a mix. The landlords are not in the lending business. And if they're suddenly offering, or the broker's offering 15, 20, 30, $40 per square foot, it sounds fantastic. But again, the landlord's not the bank. They're typically going to bake it back into your base rent's annual increase, and then it becomes like a loan you can never really pay off that just keeps on going up and up. Then when you renew your lease at year 5 or 10, it states that it's then at the ever greater than cost. So now suddenly you've now committed yourselves roughly to 20 years, right? At a rent rate that might have started above market price. At 10 years, it's definitely above market price. And probably after 20 years, you might be double market. And then last thing, landlord work. There's lots of different components and avenues to do. What should we do? Obviously, it should be fair and affordable rents, should give you the stability and security, and ultimately the predictability of cash flow. When you go through with your financial team to evaluate, practices to acquire, one of the first things a bank will look at is there sufficient term of the lease? I was just in with RBC's team recently doing some team training with the national team here in the GTHA, specifically for healthcare. And what they basically said now, because Leases and landlords are such an issue. If there is not 12 years worth of term and transferable options for the lease, they will not give a 12-year amortization period on the loan.
Mhm.
So if this is the first you've heard of that, it's very common now where rule of thumb is, right? The bank wants to make sure that if you're going to spread out the payments over 12 years, they want to make sure you've got a rock solid lease and they don't come back to them 2 years later to say, oh, shoot, right, Ryan, I need another 300 grand because I got to go move across the street at 350 bucks a square foot. So term and options become critical, and minimizing any sort of demolitions, relocations, or techniques to minimize those as we go through. Risk and exposure, right? Did you know that the vast majority of new standard form leases include a landlord's right to demolish the building with as little as 6 months worth of notice? Right? Many leases today include a relocation provision that with as little as 2 or 3 months worth of notice, right, they can actually move you to any other suite in the building. Everybody talks about the demolition clause. Very few realize the relocation clause could even be worse. They can force you to move, they can lock you in at the ground floor rates, and they can put you at any other place in the building, right? And in many cases, only cover moving or incidental type costs. Maximizing your flexibility, right? And protecting that. So one of the big takeaways, and one of those for those of you taking notes, the death and disability clause. The death and disability clause is ideally should be in each and every doctor's leases across the country. It's a very specific technical piece of language that, in essence, gives you a termination right that, heaven forbid, if you were to pass away, right, or become incapacitated, like my godfather, and tears rotator cuff golfing, right, the more things you can do in advance to prepare yourself for that eventual sale and protection, heaven forbid you were to pass away, is critical. So there was a devastating example of a doctor north of the Toronto area who had built it a beautiful 6 operatory clinic, and devastatingly, 3 weeks prior to the grand opening, the doctor died of a massive heart attack. Fully built out clinic, no doctor, no patients, right? I know Ryan's on mute, but doctors, how much is that clinic worth? Right. And unfortunately, right, the answer was zero, in some cases less than zero. The banks were able to recoup the loan based on the life insurance policy. The landlord then went back to the spouse and said, unfortunately, Mrs. Smith, you're now responsible for the roughly $9,000 a month, increasing at 4% per year for the remaining 9.5 years on the lease. I share that because, had that doctor in the renewal or in the new start negotiation, right, had they had the professional representation, we could have added something like that in, which could have given the spouse the ability to say, Ryan, Mr. Landlord, here's 3 months worth of notice, I'm done. Now, unfortunately, to this day, even after the lease is assigned, which took quite some time, right, the estate is still a guarantor indefinitely, right? All from the original provisions of that, letter of intent that was signed, on the trunk of a car when they originally opened the clinic. Lots of great recent examples. So, here's just, prime example of a doctor in Eastern Ontario. Lots of great wins, right? Tenant Improvement Allowance, free rent, limiting on personal liabilities, removing demo relocations, getting exclusivity, right? You don't want to have a GP or specialist opening up right next door, and especially not a DSO. That could be devastating for initial production. So protect yourself. If you're a GP, right, what happens if you get an ortho that negotiates exclusivity over the subspecialty of orthodontistry, right? Could that prevent you from doing phase 1, phase 2, or Invisalign? Right. So, no different than a Tim Hortons that tries to sell pizza next to Pizza that's got exclusivity, right? The same things can apply in the world of commercial real estate. Don't forget, this isn't residential. There's not all these different sort of protections, etc. This is two business entities agreeing to a specific contract. Lots of key things. Another great example, recently we did a great webinar with Dr. Whitaker, who's created Dental Hive. We've done multiple different locations for her in the past, and this was a fantastic example of where we secured over 100,000 worth of tenant improvement allowance, lots of fixturing, limiting those personal guarantees. Yes, Every landlord is going to want some form of a personal guarantee, but it doesn't have to be forever and ever. And it certainly doesn't have to be post-sale. Lots of different step downs we can do. Relocations, demolitions, option to renew, all of which very, very negotiable. It just takes an incredibly long amount of time, and it leverages the over 13,000 leases that we've done over the past 30 years in business. So owning versus leasing, right? Ryan, I don't know about you, but I get this question all the time. And 57% lease now versus 43. So, our perspective is, look, right? Let us evaluate both opportunities for you, right? Let your financial advisors evaluate both as well, right? What's the cost of money? What's the best deal we can get you to stay in your current space? And what would the landlord down the street do? Because it's a rough time to be a landlord right now, right? Rates have gone up, right? If vacancies have gone up and the landlords are now struggling to pay and cover some of the rents, that's a problem. So, the pros and cons are, of course, right? Big upfront, large upfront financial investment. You really do commit yourself to a space. If you're building out for $1 million at 350 a square foot, if you're buying a piece of real estate, right, for another $1 million, you are pot committed. And if the roof leaks, if there's asbestos, if there's zoning issues, I can think of 3 locations recently where the doctor has bought and cannot build out a dental clinic. Zoning, right? The condo board won't allow them to upgrade the electrical, right? Or in many cases won't allow for the specific coring in the space, even though they own it. So be very careful and make sure that you've got the professional team going in, doing the analysis, evaluating the piece, and supporting you throughout the process. Obviously, leasing, right? For a younger doctor, for their first clinic, or looking to add a second or third, it's interesting. A lot of the DSOs, they don't own the real estate. Why? Right? Well, in many cases, as you go from one location or 2 or 3, right, there's can be a lot more value to sell 3 locations fully running and running by associates than just a single one. So, right, a lot of the larger groups or those that are focused will take that extra dollar of capital, go and reinvest it into the clinic, grow the clinic, or add a secondary location versus tying that up in real estate. Anybody can buy the real estate, but right, design what's best for you. In either case, the lease becomes very, very important. And I did a great piece with Oral Health Magazine and Dr. Jordan Soul, and he shared his perspective. And Ryan, this was a great one. Part of the wills and estate planning, which we touched on. We didn't add that to the question, but if you haven't done it, please let us introduce you to someone who can. But what he does is every 5 years, he'll get a practice valuation done. He'll have us update his lease that separates his real estate corporation from his practice corporation. And then his best practice is, heaven forbid, if he passes away, right? He basically says to his wife, open the top drawer. If I die, break glass. And here it is, right? Here's Ryan's contact information, right? Here's Cirrus's contact information to sell it quickly. Here's the practice valuation, and just get it done. So that's key. Anything else to add, Ryan, from your perspective, when doctors ask you about buying versus leasing?
I'll jump into some of the tax benefits of it when I go through my presentation. That would be one of the biggest things I'd suggest. Yeah.
Perfect. Perfect. Great. So as we transition to Ryan here, one of the key things are, in the essence of time, are if you are leasing, do you know when your lease expires? What's your option to renew deadline date? Are you personally liable? Are you liable after you sell? For those of you that own, right, have you, and hopefully not, but do you own the real estate under your professional corp? Right? Is there, if not, right? Is it your spouse? Is it in your name personally? Right? Is your practice incorporated? The other question is, are you paying yourself rent today? Right? There can certainly be some tax components there, and certainly different ways of structuring it. And then the big question is when you do want to sell, do you want to keep the building as a passive form of income? If not, at some point, that lease becomes very, very important. So for the 43% that own, right, very important to find out, hey, what is market rent? Is my lease, hey, it's something I set up, 3, 4, 5, 10 years ago, right? What can I now do to make sure that I'm prepared, heaven forbid, if I passed away tomorrow, right? How do we help to protect ourselves from it? The big piece is the sale. The sale My God, the number one reason why a practice sale dies at the 11th hour is because of the lease. If you want to do a quick screenshot, this is a fantastic one. These are just some of the dozens of clauses we go through. Death and disability, I mentioned. But ultimately, even the tiniest of clauses can have hundreds of thousands of dollars of impact. So just one I'll share is this. This is the assignment clause. We pulled this from a recent lease in the country, dental, right? And a standard form lease language. So typically I'll say, hey, let's go through it and find all the red flags, right? And then who enjoys reading leases? We're sort of like going through a tax return, right? But for those of you that might not be aware, you cannot buy or sell a clinic, right, without the landlord's written consent, right? What's the clinic worth without the keys, right? If you're not, just buying charts, it's going to be a condition of financing and the assignment of the lease. So the landlord now has the control. And of course, they want to know who's moving in. But of course, now it gets a little trickier. So hidden away in Article 6, subsection 2, it states that, right? The landlord can say yes, can say no, right? Or number 3, can actually terminate the lease just for asking to sell the clinic. And this happened to a doctor that recently reached out to us in South Edmonton, that the landlord put the practice on hold, right? And the whole sale on hold, and right, used clauses like this to increase rent dramatically in conjunction with the sale. And then even worse, look for the word consideration. That's the loophole the landlord uses against the doctor to actually require a percentage of the practice sale proceeds. Now, this exact clause was pulled from a recent dental lease that basically specifically stated, paraphrasing, is that any money that you get for the leasehold improvements, right, meaning the floors, the walls, the plumbing, etc., right? You look at a tier 3 valuation and it'll basically say 100 grand, 150 grand, etc. The landlord basically says, that's my money. That's not your money. That's my money, right? And how much is your clinic worth without my keys, right? So these are, again, could be hundreds of thousands of dollars. This one doctor had to pay 10%. It was $1.4 million just to facilitate the sale. And lastly, right, beware the continuing liability. I will bet, and I won't pull up a poll, but I'll bet that roughly 90 to 99% of the people on this call that we haven't worked with in the past will have a lease that will keep them personally and as continually liable as they are today, even after they've sold, retired, and moved down to Florida and, enjoying a long-term retirement. Almost every single standard form lease requires the selling doctor to remain liable as long as that lease continues to renew indefinitely. That obviously can be very negotiable, but it can create a ton of strife. And all of the tax planning, estate freezes, and otherwise at the end of this piece, if you've got to write a 6-figure check to the landlord unnecessarily, it is just heartbreaking. So how do we fix it? We start early. Start the process at least 2 years prior to the expiry. If you're looking to move in or acquire, etc., the more time, the more leverage. 30 years in the business, right? We've done over 13,000 of these. Start the process 2 years prior. What does the landlord do? Defer, deflect, slow down, etc. Big issue, right? We want to come up with a plan and proposal, ideally 2 years out. Why? Because to move a clinic in Ontario, N or BC or PEI, it can be anywhere from 18 to 24 months. Zoning, permits, right? Build outs, unbelievable. So best thing to do now is, right, get all the information. Find out your signed agreement from way back when in 1986 and all the renewals, expansions, assignments, etc. Figure out your goals. Have your lease reviewed. Prepare the market research, right? Find out what demographics are, rental rates, etc. Right? And then how do we help to make sure that we have a good long-term strategy around the long-term saleability of your clinic, right? And figure out the outcome, right? What's the production? What's the production per chair? Thinking about your clinic through the eyes of your buyer is critical because that's ultimately the one that needs to realize, hey, is this designed for me? But what have we not done at this point? We haven't picked up the phone and called Ryan. Hopefully you've called Ryan, but we haven't called the landlord. So make sure, don't jump into the clinic tomorrow. Wow, I went to this great seminar with Ryan and I'm going to call my landlord and start renegotiating. Don't skip the process, right? Once we've done all the due diligence and looked at it like a carefully choreographed game of chess, then negotiate the financials, then negotiate the business clauses. And don't stop until we get to a final form lease agreement that you're satisfied with. As we pass through, as I pass it over to Ryan, one of the key pieces, again, in appreciation for everyone's time is as you go into the end of the year, it's a perfect opportunity to do a quick reset, right? Look through your wills and estate planning, right? Have your lease professionally reviewed, compare to see if you're paying market price or not, right? If you own your building, it is a fantastic time to have a conversation. We waive our $2,000 fee, right? We'll do a full real estate analysis, demographics, right? All at no charge based on your attendance and registration for this evening's course, right? And then more importantly, what it does is to help make sure that if it's, oh, I'll figure out a lease for myself down the line, or, oh, I'm my own landlord, it doesn't really matter, right? The ability now to help develop a plan and to be prepared, heaven forbid, something were to occur, etc. It's just good it's good planning, right? As we plan for the next step of our career. Perfect. On that note, Ryan, I'll let you share and we'll cover some Q&A at the end, guys. I see the Q&A is starting to buzz through, right? We'll touch on, looks like some good questions about good assets, bad assets, capital gains exemptions. So let's jump right in, ladies and gentlemen. So feel free to put it into the Q&A, which we'll cover at the end, as well as the chat as well for any specific questions. Ryan, over to you.
Perfect. Can you see my screen okay?
Got it. Perfect.
Perfect. Excellent. Thanks, everyone. I'm going to talk about tax today. We're going to go through a number of different things today, inclusive of the capital gains change. And so I'm going to dive right in. I've worked pretty much exclusively with dentists across the country. And we'll show you just in the next slide, the number of offices that we have. Ultimately, I'm in London, Ontario, and still service dentists remotely from here across the country. We're going to cover the main tax budget impact, which was the capital gain change, and see what that looks like corporately and personally. And then we're going to go into some tax challenges and some solutions, and then we'll knock off all your questions at the end. So as you can see, the number of offices that MMP has across Canada here. I'm right here down in down in the tip of Ontario. The big thing that we're going to go through right now is the fact that in the last federal budget, they made a pretty significant change. That was about a June the 25th change, and there was a lot of concern at that time as to what that looked like. There was a corporate change and a personal change above $250,000 per year that ultimately increased the tax overall. It was basically a retroactive tax. If you had any pregnant gains up to that June 25th date and you didn't trigger them, you are effectively burned in that respect. When we look at this, what was the corporate change? As we flow it all the way through pre-June the 25th, and these are Ontario rates today, it was about a 29% effective rate on the capital gain, and we've gone up to 38.62. So it's a 9.65% increase on all capital gains. That is any stock that you owned and that you later sold. We're looking at effectively a 10% increase there. It's also, though, the shares of your dental professional corporation if they don't qualify for that lifetime capital gains exemption. So I'm actually working right now on a $20 million sale, and it's a share sale. It's literally a $2 million differential on that sale. Luckily we were able to trigger the gain before June 25th, but the sale hasn't occurred. And if it gets too far down the road, we may have to back out of that transaction. As you see on the personal side of things here, we've got all the calculations that flow through, again, in Ontario, but the differential here on anything above a $250,000 capital gain is an 8.92% tax rate increase. So that's pretty significant. When I go back to the corporate, it's almost 10. When I look at the personal on anything above 250, it's approximately 9. So not ideal. Some substantial tax increases there. So we're going to look at some solutions because not all solutions, but we'll look at some solutions here. So in my world, we run into some main dental structures. Most people have one dental professional corporation, and most of the time, it's a dental professional corporation per location, like physical location. And one of the main ways that we can avoid this capital gains tax is this tax-free sale, that lifetime capital gains exemption. So when they brought in the capital gain rate increase, they also increased the exemption. They increased it to $1,250,000. And we'll talk about the impact of how significant that is just a little later on. But one of the main ways for probably most of the people on the video here today, if you have a practice and you're looking at, how do I sell my corporation in the future? There's a couple different things that have to be done, and that you have to plan similar to the way that Eric was talking before. You have to plan substantially in advance. And in my case, it's usually even more than 2 years in advance. And so a couple of those things that we really look at, one of the mistakes I find all the time is that, a dentist buys a practice and it's just them on that practice as the sole shareholder, and they pay off their debt. And as they're paying off their debt, they're actually accruing share value. And it's eventually they paid off all of their debt and all that share value is in their hand. And then they work really hard during their career and the practice increases in value, and all that value is still in their hand, in their own hands. So one of the things that we can do quite easily is stop the value accruing to them and start to add additional shareholders. And for a dental practice, that's a spouse, that's children, that's the parents of the dentist. And when we look at that, depending on how many children you have, it adds a lot of additional share sale value. And when I say share sale value, I mean, if there's 2 people, that's 1.25 million per person on a husband-wife situation, $2.5 million of coverage on your sale, where you would pay 0 tax, as opposed to what you'll see in a little bit later slide, something closer to $900,000. One of the main other issues that I run into in people with their dental professional corporations are dentists are typically quite profitable, and they leave a lot of money behind in their corporation as opposed to paying high rates of personal tax. And so they end up accruing a whole bunch of additional assets in their company, cash, investments. They loan money over to other companies. And one of my main issues in terms of trying to do one of these tax-free sales is that when we get to the 11th hour, they've got too much of that in their corporation, and they've thrown themselves offside for some of the tests that have to happen to be able to take advantage of that tax-free sale. One of the other things that I'm highlighting here is something called a super purification. I kind of coined that myself. And so, one of the things that we can do, because dental practices have so much goodwill value associated with them, is we can do a purification in excess of those redundant assets, so that and that one's super useful in terms of the fact that as I do one of those purifications over the value of what your hard assets are, I'm systematically bringing down your share value, so that we can bring other shareholders in and basically give them value almost immediately. So that's a really good one. And one of the other things that we're looking at here is a DPC2. And so that's also a purification technique. What I find for most of my dentists, as they're starting to get rid of all of their debt within the practice, we put this second associate corporation in place where we charge, a 40 or 50% associate fee into the operating company to suck out all the excess cash so that we can use that as an investment vehicle. And that allows for ongoing purification. So, just in case, you were to get hurt or pass away, you are in a position where your heirs could take advantage of those lifetime capital gains exemptions. So a whole bunch of different techniques here for people that have their own dental practice and are looking to specifically take advantage of a tax-free sale. It's become significantly more important now that they've increased the capital gain rate by approximately 10%. The same thing can happen on your dental building corporation. So quite often we put a dental building corporation in place. If you own your own specific building, you just have to occupy at least 50% of that building for it to qualify for the lifetime capital gains exemption. It also has to be a pure company that only has active assets, and so mostly the building within there. The neat thing about these dental building corporations is you can buy it, you can depreciate it for your entire ownership, and then you can sell it for share value, paying no tax on the exit. So the reason why I like that is if you were to sell the asset instead, you'd pay something called recapture tax on the depreciation. If instead we sell the shares of the company, we can have enjoyed the depreciation over time, paying less tax overall, and still get a tax-free exit on the whole situation. There's very few transactions where purchasers are willing to buy buildings for share value. In dental, I see it happen all the time. So you are definitely in a unique industry in that regard, which is pretty neat. And then similarly, we are allowed a couple different shareholders. Like there's no limitation in shareholders on your dental building corporation. So quite often I see myself putting discretionary family trusts as the owners of these dental buildings, which give us a lot of flexibility and additional multiplication of that exemption if and when necessary. So if we look at down here, kind of the DPC2, the Dental Professional Corp 2, that as I was talking about, that ongoing purification. The reason that we like this is because this is where we can keep our passive assets, our cash, our investments, our permanent life insurance policy. You can get involved in healthcare spending accounts on that side of things and not have to loop in all of your employees. Definitely quite a strategy that we've been employing for quite a while. And then, even one of the other highlights here is, quite often people end up with either, residential or commercial or real estate portfolios completely off the side. And one of the things that we've highlighted is that, that discretionary family trusts will allow me to skip generationally the capital gain on your ownership of the dental building company or just the investment real estate holding company. And so we've seen a huge uptick in these discretionary family trusts as the owners of private corporations, such that we're trying to avoid some of this 10% increase in tax. And there's a whole pile of other structures that you might see. You might see a hygiene company, depending on the situation, more of a DSO structure, some cost sharing or corporate partnerships. I'm not going to get into those today. These were really the ones that I was highlighting specifically to work towards avoiding that 10% tax increase in specific ways, either tax-free sales or more of a generational transfer through a discretionary family trust. So if anybody has questions about that, you're more than welcome to contact me at any time, specifically related to the family trust. Those ones are quite exciting and not a lot of people I find really understand them. As we get into some compensation planning, the government's taken away a decent amount of our flexibility here. They've got rid of capital gains strips at the end of last year. They've really limited income splitting. So if I'm just to go through more of the traditional remuneration planning, and I bring this up, as we think about these capital gains, we still have the benefit of using $250,000 of personal capital gains at the low rates. So, on the personal side of things, people are going to want to take advantage of that. But as we're looking at getting money out of dental professional corporations, in line with 92% of the people here being incorporated, we're looking at probably either a straight salary, which, comes with, all of these things, RSP room, IPP, potential health spending account, and CPP contributions, or we're looking at dividends. What I get asked a lot of the times these days is, should I invest corporately or should I invest personally now that the capital gains rates have gone up on $1 within the corporation? And so what I've found is, it still makes sense to, if you make all your money corporately, most of the time it still makes sense to do your investing corporately. I'll show you the tax rates personally to get the funds out of the company. They're pretty ugly, and so we would like to enjoy as much of the deferral of tax as possible. There's really two things in tax: you either have deferral or true savings, and we don't have a lot of true savings options anymore. We're working on deferral most of the time. There are definitely some insurance strategies that you can employ. Quite often I find myself selling some personal assets to corporations depending on the situation. Somebody turns their personal residence into a rental property and we sell it to the corporation and unlock a whole bunch of, either tax-free money, or we've used their capital gain, a low rate of tax to get the money in. So there's certain situations that works, and never forget about the, paying family members reasonable wages for efforts employed. And if they're working a certain amount of hours, we can also start paying them dividends. So it's just a quick slide on compensation strategies as we look to some of our capital gains benefits being taken away. What I find is, I'm going to go into it right now. The rates here in Ontario are pretty terrible. They're pretty terrible across the country, I'm afraid.
To say the least.
Yeah, right. We have been doing our best to cap clients within these lower rates. The 150 has been pretty popular for quite a while, but I'm finding with this inflationary environment, it's not enough for most people, and so they're inching their way up this scale. So these are salary rates for what it would take to get money in your personal hands out of a corporation. So, what can we do to avoid some of those rates and exit with a tax-free win? Well, like I said before, if you're trying to sell your dental practice, don't have permanent life insurance in there. It can throw you offside for some of the tests. Permanent life insurance belongs in a different corporation, not your practice. Don't have a whole bunch of stocks, bonds, GICs in your dental practice that also belong somewhere else. Vacation properties, absolutely not. Rental properties not in your practice corporation. All of the properties belong in a separate corporation that is not a professional corporation, for liability reasons, for financing reasons, for a whole pile of reasons. I run into this one all the time: multiple locations in one corporation. I recognize this accounting may be simpler, it might be a little cheaper, but it does create a mess for the future as you're trying to sell one location to the and not the other. It can really cost you there. And then, yeah, the other big common mistake is only having one or two shareholders, not enough shareholders, and not having the right kind of shares. The right kind of shares is also a very costly mistake. So, I'm just going to run through really quickly what the tests are for the lifetime exemption. So to get the 1.25 million per person, you have to have greater than 50% of the assets for the 2 years leading up to sale in your DPC. So what that means is don't have too many investments in your company leading up to sale. Don't have too much cash in your company leading up to sale. Don't have too many loans to other companies in your practice corporation leading up to sale. And then similarly, right at the point of sale, it has to be substantially just the practice. So the equipment, the goodwill, not a whole bunch of cash and investments. And so here's a list of all the things that are passive. Um, as I was outlining the related party loans, the life insurance, the real estate, etc. And when we set up the appropriate shareholders to be shareholders and multiply that exemption across, mom, dad, wife, children, and minor children count. They just come with some additional nuances. They have to be shareholders for a minimum of 24 months. That's a minimum for the exemption. We would generally need them in for quite a bit longer than that for value to accrue in their hands. And so, if you don't understand this, definitely speak to a tax expert. When I started into the working with dentists, the practice values were skyrocketing, and nobody had the appropriate coverage of shareholders on their practices. And so we started to very quickly freeze the dentist owner, redeem their shares with their remuneration, and we put on their spouse, their children, and potentially their parents. And there's nuances with their parents. There's nuances with the children that have to be considered before you do that. I don't always want the tax tail to wag the dog, but if there is tax to avoid, we would prefer to do that. So if I go back to, kind of sale planning here, when we have too many passive assets in the company, how do we fix it? Like I said before, that DPC2, where we strip an associate fee on a monthly ongoing basis, or we do something called a purification transaction. And when we look at having too many shareholders in place, what do? We add all these shareholders as quickly as we can. When we look at this $1.2 million, $1.25 million lifetime capital gains exemption, how much is that? Just for one person, it's a sale savings of $446,000 per person. So we've got this little picture here, know the rules. It's incredibly important if you're trying to unlock that kind of value. I've got a quick example here of somebody that sold a $2.5 million practice and they were unincorporated, and the tax, and this happens, like there's dentists that are not incorporated that run practices in their personal through their personal tax return. In that case, they sold for 2.5, they paid tax of $869,000. If instead there was one person on there and they were incorporated and they used the one person's exemption, the total tax was $423,000. They saved the 446 that I talked about before. And if they were structured properly, they paid zero tax, saving the entire $869,000 on a $2.5 million exit. So examples like this get magnified when you look at a practice that's 3 million, 4 million, $5 million, and especially when you layer in if you owned the building in addition to that practice sale value. So incredibly important. At the end of the day, the takeaways are do your tax planning early, understand the rules. I usually get people set up as soon as I meet them the correct way, so I don't have to think about it on the go forward basis as we continue to work together over time. Consult a dental tax expert, and then just do it right and do it once is kind of the key here. A couple of the other things, the capital gains inclusion rate is going to affect everybody. It has significant impact on your estate planning, your retirement planning. And then, yeah, at the end of the day, we've got some questions and I can throw it back to you, Eric.
Perfect. Thanks, Ryan.
Nice.
Every time I see that, I mean, 446,000, 863,000, it's just
Ugly.
oh. Oh, what a country we live in. So yeah, lots of good questions, guys. I mean, what a year too, right? Market rally following the election in the US, lots of interesting momentum. A lot of doctors are seeing their portfolios at record highs. The Canadian housing market, right? Lots of little resilience. Again, potentially triggering some more capital gains for you. TSX even, right? Wasn't they certainly didn't we didn't think it was going to be this type of an example over the course of the year. And then, of course, for those of you that are dabbling in Bitcoin, I mean, uh, unbelievable. So let's dig into some of the questions. Let's start with some of the first. And I think we might have covered it, but the first one came in from an anonymous one. So, clarifying some of the good versus bad assets to qualify for the capital gain exemptions. How does intercompany loans affect capital gains and that sort of 2-year waiting period prior to sale? Touched on that a little bit, but the intercompany loans, and again, what's that sort of, should it be a 5-year roadmap, a 10-year roadmap? It's never too early, right? Ryan, your thoughts?
Yeah, it's a good question. I mean, I put up a slide really quickly just in terms of what the passive assets are. And what I find a lot of people do is they do move the investments or cash out of their company, but they just move it over to one of their other companies. And so it's always due back to the dental practice. And so that's an offside asset, right? If it's just going over to some investment company somewhere, it is offside. The only case where that might not be the situation, I believe, would be as if it was going over to the dental practice building, and that was also being sold at the same time. We might be able to get away with that because it's active and active. Um, might be able to amalgamate the two together or do something before sale, but generally you would want to clear that intercompany loan. You'd want to clear out any cash surrender value life insurance or any permanent life insurance policy. You'd want to clear any due from shareholder account. So anytime that you've drawn money but you owe it back personally, you'd want to clear that. Any cottage, any investments, anytime there's too much cash. So typically we put a very active plan, or at least I do, in place to avoid that ever happening. And when I meet you, if there's a whole whackload of that in your practice, we would do something called a single wing butterfly transaction to spin it out to somewhere else, put you on a purification path, and then set up a secondary structure there to keep you pure, so that we're always ready to go. And that's one of my biggest concerns is, you get some random offer that's amazing and you tell me, hey, I want to go with this, and we can't without substantial tax. So
Got it. Got another one here, and I'll pull up a little exit poll as well. Again, a bunch of you have sort of asked to connect with Ryan afterwards, and Ryan's very graciously for all our clients, et cetera, to have a follow-up conversation, et cetera, with Ryan or a member of his team. And there's a quick poll that you can request that there, as well as we can pull up the demographics for you as well and give a good planning for next year. And certainly if you haven't looked at your lease, or if you haven't set up a lease for your building and your practice, happy to have a conversation to talk about rents and markets and trends for that. Ryan, you mentioned the Dental Building Corp, and the question there, and I had the same one, is the Dental Building Corp the same or different from what might also be known as a real estate holdco?
it'd be the same, but it would have only your dental building in it. It wouldn't have a whole bunch of other real estate of any significance. And that dental building that I'm talking about, you would occupy, at least 50% of it, or at least 50% of it when you go to sell. uh,
Got it. Yeah, so many that, buy the building and then there's another tenant or a tenant issue, or they put a rental upstairs, and my kid's pedodontist lost 4 operatories because they left the
yeah,
bath running, and
yeah.
all the challenges. Another good one is so minors and family dynamics. Now that's a whole other conversation for another day and wills and estate planning. And, gosh, that's a big response, a big number for the family.
Mhm.
But thinking on the positive for a second, the question here is it possible to make minors shareholders, or what are some of the nuances around it? I know you covered it briefly. CRA implies that the family members should be actively working in the business. To be shareholders, is there a way around that?
Yeah, so you can have minor children as shareholders of your company with no issue, as on the dental corporation or on the holding company. Um, you can sell the dental corporation and they can be shareholders at that point in time and use their own exemptions. The issue with a minor selling and using their exemption is you as the parent don't have access to the funds right away because they're minors, they don't have capacity, and so it has to stay basically in trust in their hands until they reach age of majority. You can have access to half of it, you just can't have access to the whole thing. The comment with respect to them being active in the business, that's only in relation to something called TOSI, tax on split income, and that's with respect to issuing them dividends or remuneration. It does not apply to them holding the shares and then selling the shares and unlocking that capital gains exemption. The question I get a lot of times is why I don't want to use my children's exemption and I want to let them use it. Well, I find 99% of Canadians never use it. And if anybody has the capacity to use it early, which is fully my guidance. The situation that concerns me more is what happens if they have shares and they start to, and they reach past 18 and start into their own relationships. What do we do then? And so we've got some strategies around that in terms of freezing them out at that point in time. But yeah, there's definitely, you have to trust your children. So it's not for the
Tough,
faint heart.
tough indeed.
Yeah.
Ryan, we commented a bit on this a little bit before, and this is all good tax planning, but still, we both have mutual clients, many of which that haven't done the first step for that sort of wills, tax
Yeah.
planning personally, and or created a will for the estate. For those, or might not have created a lease for themselves, or have done any of this tax planning, but especially the wills and estate planning, especially for doctors that are, after the big December 31st rush. What else can you advise, cautionary tale, etc., to really motivate? I didn't until I, bought Cirrus before I really did the big life insurance and corporate, right, wills and estate planning, etc. But, from that perspective, Ryan, again, lots of your clients on as well as ours, but what can you share about the wills and estate planning and or the need to update it?
Yeah, good question. It's ironic you talk about it because I was in a meeting earlier, yesterday actually, and it came up with a couple, and they absolutely hate the individual that the children are going to, and they haven't updated their will in 12 years. So it is very important. It usually comes up in these tax planning, tax reorganization situations where we look at things and say, what's your primary will look like? Do you have a secondary will that deals with the shares of your private company so that we can avoid probate? Oh, are we adding your parents as shareholders in here? If we are, we need a secondary will for them such that the shares come all the way back to you if they were to pass away. And I get that question all the time as well. If I put my elderly parents on as a shareholder, what happens when they die? Well, we actually can use the exemption in their final return. And if you've got that secondary will, the shares will revert right back to you with a stepped up cost base. So
Interesting.
yeah, there's some good planning there.
So what you're saying, in other words, is there's two certainties in life. There's
Yeah,
death and there's
taxes.
taxes,
Yeah,
right? Plan
got them
accordingly for
covered.
both. Yeah.
Yeah.
Another good follow-up here, guys, and appreciate your extra time, Ryan. But
Yes.
so one question here is, do you suggest two different corps for two different offices? Is it possible to change that arrangement later on? I believe it's hard to establish credibility with the new corps, with landlords, et cetera, et cetera. I can touch on it from the landlord side, but Ryan, maybe from a practicality type of
Yeah.
perspective.
Yeah, usually at each separate location, I usually have a separate corporation, and it's strictly for the fact that I don't know whether one's going to sell at differing points in time, and I always want to use the exemption. And if they're together, it's very easy to put them together later. We just amalgamate companies, but spinning them out and separating them at a later point in time is much more difficult and will likely come with some HST implications on that spin out. So yeah, with all of my structures, it's always separate location, separate corporation.
Perfect. And from the landlord side, again, if you look at it from their perspective, of course, they want to make sure, right, hey, I'm committing, this doctor's committing to $7,900 per month. What happens if, right? And COVID caused both tenant and landlords to realize, hey, the proverbial crap can hit the fan. Where are all my hooks into, and how do I make sure that I'm made whole? So from a perspective, for sure, tax advantage can be far better. The landlord, again, is a person, and therefore we can figure out, maybe they want a personal guarantee, and can we limit that to the first few years? Can we do a burn down rate? Can we put an extra security deposit? There's probably a dozen different strategies that we can do to help make sure that you can do a completely new corp. Ideally, of course, standing on its own, or maybe there's a bit of a cross guarantee for the first few years, or until your initial corp pays the whatever first 12 months worth of rent on time. We're, again, experts at that, at helping to mitigate that guarantee and risk into the piece, and also helping to, right, again, we typically don't want the doctor to deal directly with the landlord, because they'll find out all sorts of stuff and then try to lock you into as much as possible and decrease a lot of our wins. So by having a good plan in advance, by having a good, here's our goal, here's our walk away, and here's all the different step downs, when the landlord says no to a separate corp or otherwise, there's, again, a whole other cornucopia of ways that we can help to still mitigate that personal guarantee and personal liability post sale, etc. Last one that's popped up is, Ryan, if you have other shareholders but don't maximize using it, can they use it for the rest in the future only once? That's, I believe, referring to the personal capital gains exemption.
Yeah, if you use those shareholders a portion of their exemption on the sale of your practice, not all of it, they can use the residual part on a separate sale, whatever that might be in the future, without any issue. Yep.
Got it. Perfect. Great. Well, I know we've gone a few minutes over. I think we still have, well over 3/4 of the people on. So, Ryan, again, I can't thank you enough. I can't thank you enough for your extra time and time away from the family. But there's so much change. There's so much challenges, and a 10% bump on top of everything else we're doing. To take that on capital gains is just
It's terrible.
terrible. Yeah, thank you. So first of all, thank you, Ryan, for doing what you do. Thank you for being hyper specialized for dentists. Thank you for being an advocate to help keep as much money in the entrepreneur's pockets and out of, right, out of Ottawa. And again, you're not alone in all of this, doctors. I see, almost half have requested a follow-up call or follow-up with Ryan and his team. So again, it's worthwhile to have a good conversation. If your financial planner and your professional team today aren't talking to you about growth, aren't talking to you about transition planning, talking to you about how to protect your eventual practice sale proceeds, and if they're not talking to you about it as you're opening up your first clinic, then it's a perfect opportunity to reach out to Ryan or ourselves, etc., for a bit of a second opinion, right? Yes, everybody's got a guy, a gal for tax or lease or brokerage or otherwise, but it's always nice to have a different opinion, and and realizing that, look, it's tough out there to be a business owner, let alone being one of the sole breadwinners. and right, the employer, and not having that historical information on business, let alone tax, let alone everything else. So, Ryan, thank you again for all you do, and thank you for joining us this evening.
Thanks for having me.
Perfect. Thank you so much. Have a fantastic evening, everybody. Thank you for joining us. We will have a recording for this, and looking forward to chatting and supporting each of you. Thanks very much, everybody. Thanks, Ryan.
Thanks.
Thanks, guys.